The business world was rocked by these significant cases of financial fraud. 2022 has been a cataclysmic year in global corporate finance, with the collapse of cryptocurrency exchange firm FTX and the legal troubles of its CEO, Sam Bankman-Fried, making headlines, as if the past year wasn't already difficult enough for investors. Last year also saw the final court sentence for executives at Theranos, a health technology company that was under state and federal investigation for fraud. Both the FTX and Theranos scandals resulted in financial losses for investors, highlighting the importance of conducting due diligence on the businesses that investors choose to include in their portfolios. After all, investors have lost their money due to corporate fraud scandals all over the investment landscape. These are 8 most significant instances of corporate fraud that have occurred in the last 40 years, and they serve as an exercise in lessons learned. 8. Z-Best. Barry Minkoff, 15 years old, opened the carpet cleaning business Z-Best in the garage of his family in 1982. Minkoff went public with his fledgling business when he was 21 years old. However, there was a catch. More than 90% of the company's customers were made up by Minkoff, and in a typical Ponzi scheme, he had to take money from new investors to pay off older investors. He almost got away with it as well. Z-Best was about to buy KeyServe, its biggest rival, which would have stopped schemes and fake customers. However, he was found out before the deal was done. Minkoff is finally out of prison 40 years later, which includes additional 5 years for a separate short-selling investment scheme. Based on Minkoff's story, the Discovery Plus streaming document series King of the Con premiered in January 2022. 7. WorldCom. WorldCom had even grander goals in mind when it merged with MCI Communications in 1997 to become the second largest telecommunications company in the United States. It attempted to acquire Sprint in 1999 in what would have been the largest merger in recent history. WorldCom's shares fell as a result of the merger being stopped by regulators, which was bad news for CEO Bernie Ebbers, who had been using WorldCom stock-backed loans to fund his side businesses. Ebbers became more desperate as WorldCom shares fell, and in 2001, he began to record $3.8 billion in company expenses as capital expenditures. After his ruse was exposed in June 2002, the business declared bankruptcy in July. The sentence for Ebbers, who passed away in February 2020, was 25 years in prison. 6. Wells Fargo. This enormous bank can't seem to stay out of trouble with the law. Wells Fargo was fined $3.7 billion on December 20th for illegal activity involving the mishandling of 16 million customer accounts. Wells Fargo repeatedly misapplied loan payments, wrongfully foreclosed on homes and illegally repossessed vehicles, incorrectly assessed fees and interest, charged surprise overdraft fees, as stated by the Consumer Financial Protection Bureau. Wells Fargo was fined $100 million in 2016 by the Consumer Financial Protection Bureau, CFPB, and the Securities and Exchange Commission, SEC, eventually levied $3 billion in fines of its own after overworked employees were encouraged to open approximately 2 million fake customer accounts. In the short term, the move, which was eventually attributed to senior management, increased bank profits, but in the long run, it damaged the brand and alienated customers. 5. Luke King Coffee. After spending 3 years embroiled in a legal muddle as a result of a fake revenue scandal in 2020, Luke King Coffee, which is based in China, appears to be making a comeback in the year 2022. In early 2020, internal financial analysts discovered that Luke King Coffee's growth was artificially inflated due to $310 million in bulk sales to businesses associated with the company's chairman. This discovery came after a massive initial public offering in 2019 that saw Luke King Coffee's stock rise from $20 per share to $50 in a year. Luke King management was also found to have fraudulently arranged the purchase of $140 million worth of raw materials from suppliers. Investors left the company and the share price fell as a result of those investigations becoming public. Luke King Coffee is trading over the counter now that the company has been delisted from NASDAQ and the senior executives involved in the scandal are out of the picture. As of December 20th, its stock price was up to $24.24, its most recent quarter's revenue was up 65.7% year over year, and same-store sales growth was 19.4% in the third quarter. 4. Wirecard. On December 8th, executives of the electronic payments company Wirecard, based in Munich, Germany, went on trial in what was dubbed the largest corporate fraud case in German history by media outlets. If found guilty, Marcus Braun, the company's former CEO, Oliver Bellenhaus, and Stefan von Erfa, two senior executives, face multiple years behind bars. Jan Marsalek, another high-ranking Wirecard executive, is reportedly hiding out in Russia after fleeing the country. Marsalek is currently at the top of Germany's most wanted list. After authorities discovered $1.9 billion was missing from the company's accounts in 2020, Wirecard declared bankruptcy, bringing the company into the spotlight. German regulators had claimed that the money never existed. Marsalek left the country as a result, and Braun was detained. 3. Enron. Dubbed America's most innovative company by Fortune magazine every year from 1996 to 2001, occupies a prominent position on the list of the largest cases of corporate fraud in the 21st century. The once popular .com made a lot of money trading natural gas and other commodities, and even launched its own digital commodity trading platform in 1999. It was founded in 1985. Enron shares reached a high of $90 in August 2000, but just a year later, an anonymous warning from an Enron vice president to CEO Ken Lay warned of a massive accounting scandal that could bring the entire company down. Shortly thereafter, the SEC announced a comprehensive investigation into Enron's finances, and Enron admitted that it had overstated profits by $600 million. The stock of Enron eventually dropped to a few cents per share, and on December 2, 2001, the business filed for bankruptcy. Enron eliminated 4,000 jobs prior to that announcement, draining the pension funds of many former employees. The passage of the Sarbanes-Oxley Act in 2002, which mandated more stringent accounting practices for publicly traded companies, was the only positive outcome of the Enron scandal. 2. Theranos. Theranos opened in 2003 with 19-year-old founder Elizabeth Holmes at the helm and a commitment to making the common blood test more efficient, more accurate, and much faster. Theranos was initially hailed as an innovative healthcare technology company. By 2014, Theranos was worth $10 billion, with $700 million in equity investments. However, medical testing professionals discovered that the company's highly praised automated compact testing device was inoperable by 2015. Soon after, the company was accused of fraud by state and federal regulators. In 2018, Theranos went out of business due to the burden of legal expenses. After a series of legal battles, Holmes and Ramesh Sunny Balwani, the company's former president, were both found guilty and received sentences of more than 11 and 12 years in prison, respectively, in November and December 2022. Theranos' investments cost high-profile investors like Rupert Murdoch, Carlos Slim, and Betsy DeVos millions of dollars with little chance of recovery. 1. FTX. Bankman-Fried is the majority owner of FTX, which debuted in May 2019 as a trading platform for crypto investors. Bankman-Fried had previously established Alameda Research LLC, a hedge fund with a friend named Gary Wang, which is now commonly referred to as SBF. The Securities and Exchange Commission of the United States made an accusation against SBF toward the end of 2022 that he had defrauded the investors in his companies by funneling funds from FTX into Alameda Research from 2019 to 2022. The money was allegedly used by SBF and company executives to buy homes in the Bahamas, invest in other businesses, and support favored political causes. When crypto assets plunged precipitously in 2022, both FTX and Alameda ran out of cash. According to the Commodity Futures Trading Commission, Alameda owed FTX customers approximately $8 billion, and federal prosecutors brought fraud charges. Alameda and FTX went out of business in November, and on December 12, SBF was taken into custody in the Bahamas. SBF's transfer from the Bahamas to the United States to face charges including fraud and money laundering was approved by a judge on December 21st. Never in my career have I seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information as occurred here, said new FTX CEO John Ray III, who led the Enron liquidation. Give this video a thumbs up and share it with your friends if you liked it so we can keep making more of them. Click the subscribe button for more videos like this one, and don't forget to click the notification bell. Additionally, don't forget to check out our other videos. And thanks for watching.